Why do people who seemingly have all the money in the world still borrow more of it? This question puzzles many. We are often taught to view saving as the ultimate virtue and debt as its villainous counterpart. The common narrative says, financial freedom comes from eliminating loans and living only on what you own. Yet, when you inspect the financial statements of the wealthiest individuals and corporations, you find debt. Lots of it. For the financially savvy, debt isn't weakness. It's a powerful instrument, a precise tool used to amplify wealth and accelerate growth. The gap between how most people see debt and how the wealthy use it is huge. For the average person, debt looks like high-interest credit cards for consumption or personal loans for depreciating assets like cars. That's bad debt. It drains future income to pay for the past. The wealthy, however, use good debt. They borrow at low interest to acquire assets that generate higher returns, which over time is a reliable path to building significant wealth. This distinction changes the game. This piece isn't a blanket endorsement to go into debt for any reason. It's an exploration of a financial secret hidden in plain sight. It's about the mechanics and the mindset behind strategic borrowing. We'll dismantle the common myths that hold people back, examine the specific tools the wealthy employ, and outline the strict rules they follow to mitigate risk. The goal: shift your view from fearing all debt to using specific debt as a strategic partner in your financial journey, just like the most successful investors and entrepreneurs have done for generations. The idea that all debt is bad is one of the most pervasive and damaging myths in personal finance. We hear cautionary tales of families crushed by credit card bills or individuals who lost everything to foreclosure. These stories are real and tragic. They stem from a type of debt that is indeed destructive. High-interest consumer debt used to fund a lifestyle beyond one's means. This is the debt that is marketed to us relentlessly, promising instant gratification at the cost of long-term financial servitude. Because it's the most visible form of debt, people learn to fear it entirely. But that blanket condemnation is throwing the baby out with the bathwater. It fails to distinguish debt used for consumption from debt used for investment. Borrow money to buy a new television. Its value drops the moment you unbox it. The debt remains, the asset depreciates. Net loss. That's the bad debt gurus warn against. It makes you poorer. The rich avoid that liability like the plague. Their luxury spending is usually with cash they already have. The myth persists because it's simple: avoid debt. That removes the need for critical thinking, calculating risk, or understanding the nature of assets. Simplicity can be a trap. Treating all debt as evil shuts you off from powerful wealth-building strategies. Leverage is the tool, a machine doing work your bare hands can't. The wealthy categorize debt. It's a spectrum. One end, high-cost, value-destroying debt for non-essential consumption. Other end, low-cost, strategic debt to acquire income-generating, appreciating assets. Loan for a lavish vacation, loan for a rental property. So, how exactly do the wealthy put good debt to work? The strategy is surprisingly straightforward and can be broken down into a few core principles. The primary use is to acquire cash-flowing assets. A classic example is real estate. An investor might purchase a $500,000 apartment building, not with their own cash, but by putting down 20%, $100,000, and taking out a mortgage for the remaining $400,000. The rental income from the apartments is then used to cover costs, mortgage payments, property taxes, insurance, and maintenance. If managed correctly, there's a surplus left over each month. Positive cash flow. This method achieves several things at once. First, the investor controls a $500,000 asset with only $100,000 of their own money. This is leverage. Over time, tenants are effectively paying off the loan, building the investor's equity. Meanwhile, the property itself is likely appreciating in value. The investor benefits from cash flow, loan amortization, and appreciation, all while only a fraction of the total cost is at risk. This is how real estate empires are built, with structured loans. Another application, business growth. An entrepreneur might use a loan to buy new machinery to boost efficiency. Say the loan costs 6% per year in interest, but the new equipment yields an extra 20% profit annually. That spread is pure profit. This lets the business grow faster than by reinvesting only existing cash. This is using other people's money. OPM, in this case, the banks. Interest on investment loans is often tax-deductible, reducing the real cost of borrowing. Access to a line of credit lets someone handle surprises or seize opportunities without selling long-term assets. Debt becomes a tool for offense, growth, and defense, liquidity. Let's make the power of leverage concrete with a simple, clear numerical example. Imagine you have $100,000 in cash to invest. You find a small rental property for sale at that exact price. You could choose to buy it outright with your cash. Let's assume the property generates $12,000 per year in rental income, taxes, insurance, maintenance. After those expenses, you still have $12,000 net. That equals a 12% annual return. Many people would be happy with that return, but the wealthy think differently. Now, consider the leveraged approach. You use the same $100,000 as a 20% down payment on 5 separate properties, each priced at $100,000. You take out mortgages for the remaining $80,000 on each property. The total assets you control, $500,000. Assume each property's annual mortgage payment is $5,000. Rent, $12,000 minus mortgage $5,000 equals net $7,000 per property. 5 properties times $7,000 equals $35,000 total annual profit. You still only invested $100,000 cash. So 35% return on your cash. Compare that to the 12% all-cash return. 1 house equals 12%. 5 houses plus mortgages equals 35%. That's the magic of leverage. You're earning returns on your money and the bank's money. Your capital works much harder, but this simplifies things and assumes all goes well. Risk is magnified. A downturn could be disastrous if over-levered. Still, the math shows the core principle. The goal, maximize return on deployed capital. Use low-cost, long-term debt to control more income-producing assets. That's how wealth is accelerated. The wealthy don't get rich by earning 12%. They get rich by turning 12% into 35%. To execute these strategies, the wealthy have a specialized toolkit of financial instruments they use. These are not exotic or unobtainable products. Many are available to the average person, but they are used with a different intention and level of sophistication. The most common and powerful tool is the mortgage. Specifically, fixed-rate, long-term mortgages on investment properties. The fixed rate locks in the cost of borrowing for decades, protecting the investor from rising interest rates, while inflation slowly erodes the real value of that debt over time. It is a cornerstone of most real estate fortunes. Another essential tool is the business loan and the commercial line of credit. For entrepreneurs, this is the lifeblood of expansion. A term loan can fund the acquisition of a competitor or purchase of critical equipment. A line of credit provides flexible, revolving access to capital for managing cash flow fluctuations, like making payroll before a large client payment comes in. Unlike a personal credit card, these loans are typically secured by business assets, come with more favorable interest rates, and the interest is a deductible business expense. They are used not for survival, but for strategic, calculated growth. For those invested heavily in the stock market, the margin loan is a common, albeit riskier tool. This allows an investor to borrow money against the value of their existing stock portfolio to buy more stocks. The idea is that returns will outpace the interest on the margin loan. This can dramatically amplify gains in a rising market. However, it also amplifies losses in a falling market and can lead to a margin call, where the broker forces the sale of stocks to cover the loan. For this reason, the truly wealthy use it sparingly and with extreme caution, often keeping borrowing levels very low relative to portfolio value. Finally, there are more sophisticated tools like asset-backed loans. Instead of selling a valuable asset to raise cash, a loan can be taken using the asset as collateral, unlocking liquidity without giving up ownership. They get the cash needed for a new investment opportunity while keeping the asset, which may continue to appreciate. Each of these tools serves a specific purpose: to use existing assets or future income streams to access capital at a reasonable cost for the purpose of acquiring more productive assets. Using debt to build wealth is not like playing a video game with a cheat code. It is a serious endeavor with strict rules. The wealthy who use debt successfully do so with immense discipline, adhering to a set of non-negotiable principles. The first and most important rule is to borrow for growth, not for lifestyle. Debt is taken on to purchase assets that are expected to generate income or appreciate in value, never depreciating toys like luxury cars, boats, or vacations. The second rule is to obsess over the cost of capital: low interest, fixed rate, long-term loans. A single percentage point difference can mean tens or hundreds of thousands over a loan's life. Maintain excellent credit and strong relationships to access the best terms. Treat the interest rate as a critical variable in every calculation. Always maintain a cash buffer. Never leverage to 100%. Keep reserves or untapped credit lines to defend against vacancies or sudden downturns. Lastly, have a clear exit strategy before entering any deal. Cash flow hold, sell after appreciation, or refinance. Stress test. What if interest rates rise? What if rents fall? Plan for multiple outcomes. It would be irresponsible to discuss the upside of leverage without giving equal weight to its dangers. Debt is a double-edged sword. The primary risk is over-leverage. Too much debt makes you fragile. A small dip in income or asset values can wipe out equity. This is what happened to countless investors in the 2008 crisis. Spreadsheets assume perfection. Reality brings vacancies, repairs, slowdowns. If payments are too tight, disruptions force you to feed the asset monthly, draining reserves and risking default. Variable rates can turn a winner into a loser overnight. Disciplined investors prefer fixed-rate debt for long-term holds. They manage risk through structure and diversification, insurance, and, most importantly, liquidity. Cash is the oxygen for a leveraged investor. Underpinning all these strategies and rules is a fundamental shift in mindset. The average person thinks in weeks and months, focusing on the next paycheck and bills. The wealthy investor thinks in years, decades. They are not trying to get rich quick. They're executing a long-term plan. Biggest returns come from time in the market, especially with leveraged assets paying down over time. A dip is disaster for the short term, opportunity for the long term. Vacancies are temporary, not thesis ending. The investor mindset obsesses over return on equity, not just asset return. Leverage transforms modest returns into powerful ROE. Debt is a neutral tool. Its value is determined by its application, not emotion. Reject fear-based narratives. Ask, will this asset produce more value than the interest? Is the risk manageable? Is the structure sound long-term? So, how can you begin to apply these principles? The path does not begin with taking out a massive loan. It begins with education and preparation. Learn the language of debt, interest rate, amortization, principal, term, fixed versus variable rates. Read on investing, real estate, small business. Eliminate high-interest consumer debt and build an emergency fund. You cannot start building a skyscraper on a foundation of quicksand. Start small with clear numbers, a career-boosting degree, a modest SBA equipment loan, or a low-down FHA duplex house hack. Keep meticulous records and seek trusted advice. Good advice is leverage. Remember, debt can be a path to freedom, but it demands respect. Plan carefully, measure twice, and build your future with skill, not luck.